Good morning, everyone. This is going to be part 2 of last week's webinar on unrelated business income. I'm Brandy Terwilliger, and I'm a partner here at Maynard Costerisan in our tax department. And my specialization is in the not-for-profit area, so a lot of the things that we talk about I run into pretty regularly. So I can be a resource for you if needed. Session 1 recap. Last week we talked about what unrelated business income was. We talked about going through that 3-prong test and how to determine if a revenue stream that you have is UBI. And we also talked about some potential sources of UBI to keep an eye on. This week we're going to talk about, once you've determined that you do have unrelated business income, how can we allocate some expenses to that income in order to reduce our tax liability? We're going to go through some direct expenses and some indirect expenses and some ways to allocate those indirect expenses, and we'll also go through a simple example of how to do both. And then we're going to talk a little bit about the logistics of Form 990T and just some things to keep in mind. And then I'm going to also give some resources at the end that are some helpful resources for both 990T and just 990 in general and not-for-profit IRS type resources. So here's part of the regulation that talks about the expense side of UBI. And so I bolded a section on there that says, okay, as the gross income derived, you have a regular trade or business, but this is going to be less those deductions allowed by Chapter 1 of the Code, which are directly connected with the carrying on of such trade or business. So this is going to be where we take off our not-for-profit hat and we put on our C Corp hat. Because most, if not all, of the same rules for expenses that pertain to a for-profit entity are going to apply with the 990T, because this is just like any other trade or business that you would have to file a for-profit return for if there wasn't such form as a 990T. And then it goes on to say, therefore, expenses, depreciation, and similar items not only must qualify as deductions allowed by Chapter 1 of the Code, but also must be directly connected with the unrelated trade or business. So yeah, you don't get to deduct any expenses from there. It has to be directly connected to the unrelated activity. And also, there's going to be some exceptions we'll talk about later that are the same as if you were a for-profit entity. And then one more thing in this, on the bottom, last 6 sentences, it says, in the case of an organization which derives gross income from the regular conduct of 2 or more unrelated business activities. And it talks about how we take the aggregate gross income from all activities and we take out the aggregate of all expenses and deductions related to those activities. So it's one, and I talked about that last week. It's one, you net those things together on those different activities. And this is where I talked about how there's some proposals out there that would suggest that the IRS may silo this and cause you to only be able to take expenses related to the specific activities and report those as separately. So that could come up in the future, and we'll obviously keep an eye on that. So direct expenses. So these are expenses attributable solely to the unrelated business activity. And I'm not going to read the entire definition in there, but an example noted here in bold is salaries, like a salary of a personnel employed full-time in carrying out that activity. They're directly connected with that activity, and their full salary would be deductible in computing unrelated business taxable income, as long as that deduction is allowed under Section 162. Now, Code Section 162 is noted is the regular trade or business code section, and further similar with depreciation of a building, if it's used entirely in the context of that unrelated business activity, it would be allowed a deduction, otherwise permitted under Section 167. And we'll talk about that a little bit on depreciation, the same rules that apply for Section 179 and those types of deductions. We'll talk a little bit after this too about indirect expenses. Direct expenses are pretty easy to determine. Indirect expenses is more of a controversial area with the IRS. There's really no guidance on how to calculate indirect expenses. Treasury is currently working on a reasonable allocation with examples to assist taxpayers in figuring out this allocation. Currently, it's any reasonable method with documentation, but the only time that it gets questioned is during audit, and it's usually when they're trying to reduce those expenses to create taxable income. And so we're hoping for some proposed regulations next year, and we'll keep following that. The dual use facility or personnel. We talked about dual use facility last week, but there's a couple different ways to calculate this, and we're going to talk about the example that I'm going to show you in a minute is going to be of a dual use facility, but it kind of gives you an idea of both direct and how to calculate direct and indirect expenses. So if you have a facility that is used for, normally it's used for your exempt function, but occasionally or regularly carried on, you know, you've got through the three-prong test, you're using it for a non-exempt purpose also. There's two ways to calculate that overhead, those indirect expenses. There's the way that I'm going to talk about first, which is the Rensselaer Polytechnic Institute, if I'm saying that correctly, and that was a circuit court case that is not binding but could be used in argument. And then there's the IRS preferred method. So the first method is where you take total days used for unrelated business activities over the total days the facility is used for all purposes. The other option is the total days used for unrelated business activities over the total days available to use, and that's the IRS preferred method, obviously, because in this case you're going to get less allowed expenses. So a lot of times I prefer the first method, depends on how aggressive you are, but you can always use that circuit case in the event of an audit to argue your point. So here's an example that I'm going to run through. So we have a tax-exempt organization, and we're going to name it XYZ, because I'm so creative in naming organizations. And this XYZ conducts exhibits and shows in their multi-purpose room. When the multi-purpose room is not needed for exempt function, XYZ will have special events, concerts or movies or things like that, that are not related to the exempt function. And we've already determined that they are UBI. In the current year, XYZ conducted exempt function activities in the room for 150 days, and then unrelated activities, other concerts and movies, for 75 days, for a total of 225 days used. Gross UBI income was $350,000. So some of the direct expenses that I have listed here are fees paid to the performers, the concert performers, movie rental fees, legal fees associated with being able to show the movie to the public. Say you have a special event coordinator, and that special event coordinator is the sole responsibility of that job is to find those special events that are not related to the exempt function. And then also the allocable portion of, say, the executive director's salary and benefits. You can use benefits too, so on the special event coordinator you would also include salary, benefits, payroll taxes, all those things associated with their salary. And say that executive director spends 10% of her time on those special events. So we're just going to say that after we added up the ED's salary and benefits times 10% was $15,000. So I'm showing here that we have $175,000 of direct expenses that we can deduct from that $350,000, leaving us with income of $175,000. But what about some of those indirect expenses? Those expenses that are incurred to operate the building, which includes that multi-purpose room, for the entire year, including those days that the facility was not in use. And how do we allocate those expenses to the UBI? And so I've listed some of the expenses here. So salary and benefits of the facility manager, the person who takes care of the building, runs the building. They're obviously also, you know, taking care of that multi-purpose room. Repairs and maintenance, depreciation expense, $25,000, and utilities for the building of $8,000. We have total indirect expenses now of $109,000. So these are not fully deductible, but we can look at those two options that I talked about earlier to determine how much of that $109,000 we could use against our unrelated business income. So using the first method that I discussed from the circuit court, I was trying to get out of saying it because I'm not really sure, Rensselaer I'm going to go with, method. Indirect expense deduction would be calculated this way: 75 days, which is the days we used unrelated business activity, over the 225 total days that the facility was actually used for both purposes. And here we calculate $36,333 of expenses. If we use the IRS preferred method, we're taking 75 days used in unrelated business activity over 365 total number of days in the tax year that the facility could have been used. And in this method, we only have 22,400 of indirect expenses that we could use. So obviously, this is a very gray area on which method to use, and it really depends on what your comfort level is. I tend to lean towards going with the first method and then using the court case if in the event there was a audit. If you were to use that first method and you're creating losses every year, then we might, relook at it. So it's definitely based on each individual situation on what the activity is and if you're carrying income or carrying losses. So talk a little bit more about indirect expenses and other ways to allocate indirect expenses other than that dual use property. So the IRS says it's any reasonable and consistent allocation method can be used. So that's really a gray area. As long as you have a reasonable, consistent allocation method and you can document it, they say it can be used. Now, they always can come back and argue that in an audit, but some of the things that can be used that we've seen are timesheets or other time tracking methods. So how much time is spent by certain people on those types of activities. Obviously, we said days and hours of a use of a facility. We talked about that earlier. Square footage. So if you have a portion of your building that's being rented out, that's debt financed, and that's UBI, you can use square footage to kind of determine which part of the utilities and maintenance and things like that are related to that unrelated activity. The gross income method. So total gross income from unrelated to total gross income of related, or any other reasonable method that makes sense and that you can document. So you really got to look at the method that makes the most sense for the activity that you have. So for example, if you have a country club and the country club, the golf course, and you allow non-members to come in and use the golf course. So that's not technically part of their exempt function. Their exempt function is to support their members. If you were to use the gross income method, it may not make sense because your green fees for members could be different from those for non-members. So it might not be the best allocation method. But maybe you use a method of saying rounds of golf. How many rounds of golf did members versus non-members? Or, there's just different ways that you can look at that and come up with a reasonable method that relates to that activity. That's just the best way, and so it can be very different depending on which type of activity that you have. Advertising is another form of UBI that we run into quite often, and we talked about that last week. It's income from advertising in magazines or publications, brochures, things we have on our website. And if we've determined that it's UBI, some of those, you can have your direct expenses, and this is reported on a different part of the 990T, but you have your direct expenses. So I put a couple examples on there. Cost of color, if the only part of the publication that is color is advertising. Or you have one person that's their sole job is to get advertisements, and so the salary and benefits of that individual. Those would be direct expenses. And then you have readership costs. So what we do here is we look at all the expenses that are related to putting together the entire publication. And then we take the dues that are paid to the organization and multiply it by the portion of the dues related to the periodicals, and that's your circulation income. So we figure out your circulation income, and then we figure out your readership costs. If you have a net positive, so you have actually circulation income, then you don't really get to use those excess costs. But if your readership costs exceed your circulation income, then we can also use those indirect costs against our advertising income. And obviously, if you're a client of ours listening in, we calculate all that for you here at the office. So, but just something to keep in mind if you have costs, you know, and sometimes we need to relook at those over the years when we're calculating that to make sure that we're capturing all of those costs. So as I mentioned earlier, there's limitations on certain deductions, and those are very similar to the limitations to a C corporation. So you have those limitations on related party transactions. So if you were to sell something to a related party at a loss, there's rules for that. There's the uniform capitalization rules. So like 263A, if you're selling inventory on your unrelated activity, there may be issues with capitalizing some of those expenses into your inventory until it's sold. Meals and entertainment, same rules apply. If you have, you know, 50% usually is the rule that applies there. 50% of your meals and entertainment are deductible. Fines and penalties, obviously non-deductible. So if you've paid a penalty on your 990T for late payment or something like that, or even any other penalties or fines, those are non-deductible. Charitable deductions are different with for-profit entities in a good way. So these are deductible to the 990, the UBI on the 990T, regardless of if they're connected to the unrelated activity. So if you have a 990 Schedule I where your organization is giving charitable donations, then you can deduct those from your unrelated business income without any type of restriction. On a C Corp, usually it's restricted to about 10% or so of your taxable income. So that's a real nice deduction that you can get on your 990T. And then the same rules apply for depreciation. So if you have debt financed and you're having to report rental income, you can take depreciation on a straight line method. Section 179 is allowed and bonus depreciation is allowed. But remember, in those options, if you have, we'll talk about it in a minute, but if you have state filings, they might be different for those state filings. For example, Michigan does not allow bonus. You have to recalculate your bonus, taking away your bonus depreciation, but they allow Section 179. I've had states that allow Section 179 only to 25,000 or something to that sort. So definitely need to look into that if you have state filings. So as we go through a little bit of the logistics of the 990T and the filings, so the 990T has a filing threshold of $1,000. So, and that's your gross receipts less your cost of goods sold. So a lot of times, if you're under that 1,000, you technically don't have a filing requirement. If you have previous year losses, and this year you have income of $400, you may still want to file to preserve those losses, carrying those forward. If you're reporting on a 990T because you have a K1 and you have income from a K1, it's sometimes difficult to know what the actual gross receipts of that K1 activity is. And if you're unable to figure that out, sometimes it's best to file just to be sure. The return is due on the 15th day of the 5th month, and we do automatic extensions, usually at the same time we file the 990 extension. But we do look at, to make sure if you have UBI, you still have to make a payment on extension. We can e-file the extension, but not the return. Now, this is something that we've been waiting for years to e-file the return, and you may wonder that sometimes when you get your packet, wow, we can e-file everything but the 990T. But the IRS has noted recently that there is no budget for that, so we probably won't be e-filing the 990T anytime in the near future, unfortunately, so you'll still continue to get paper copies of that. You may also have estimated payments with a 990T. If taxes estimated to be over $500, you may have estimated payments that need to be paid. And those are usually paid EFTPS, and I'll talk about that in a minute. Your tax rates are the same as the corporate rates, so ranging from 15 to 35%, depending on your revenue. And then credits are generally allowed also. So if you have a credit that's reported on form, say 3800, which is the general business credit, those are generally allowed on the 990T if related to that activity. You know, a lot of times I see that coming through on a K1. If you have losses but are able to document that you have a profit motive, you can take those losses and carry those back 2 years and forward 20 years just like a for-profit entity. So usually if we have a loss that's new this year but we've had income in the past, we always look to see if it's enough to make it worth carrying back and getting some of those refunds. Or if we know we're going to have revenue in the future, we may just carry it forward. State filings, due dates in states are different. We track all of that here at the firm if you're a client of ours. Rules on Section 179 and bonus, like I said, are different in each state. And also check your city and state filings. A lot of times our clients will have a 990T. Gross receipts are not over $350,000, so we don't have an actual Michigan CIT filing requirement. But if they're in the city of Lansing, we do have a city of Lansing requirement. So if the activity is in another state, we need to look at those filing requirements. The 990T is open to public disclosure. It's open for public inspection for 3 years from the filing date. Some of the attachments to the 990T may not be required to be for public inspection, like foreign filings. And those forms are posted on GuideStar. GuideStar just started posting the 990T in the last year, although the public disclosure rule has been around since 2006. And then, as I mentioned earlier, different types of payments, they are required through EFTPS, just like a corporation. So if you feel like you're going to have some UBI in the future or you're going to have to pay some tax, it's best to get that set up now or a few weeks in advance. It takes a few weeks to get set up through EFTPS, and we wouldn't want to be trying to do a last-minute extension and not being able to make that payment, because no one really likes to do fire drills usually. So some cautions and thoughts as we near the end of this webinar. Keep an eye on those passive income from debt-financed property. That's that rental income if you have a debt-financed property. Look for payments of rent, royalty, interest, or annuity from a controlled organization. Make sure we have documentation of profit motive if we continue to take losses on 990T. Make sure we have documentation for activities that look like UBI but are not because they're substantially related to the exempt purpose. And if you were on the webinar last week, that was talked about in that college example where the college bought the property and turned it into a bed and breakfast. Carefully review any K-1s received. And as I note in the bottom one, if you're unsure about a transaction or activity, please ask. A lot of times these come up during the year and we're never aware of them. We're not given the K-1 or we're not aware of the activity, and then it comes tax time and we're filing and all of a sudden we're scrambling because there may be tax due. If we can find out about these situations earlier on, then we can plan accordingly. And sometimes, even during the audit, we train our auditors on UBI and what to look for, but it might be, it's even better to bring it up during the year when it's actually happening so we can plan for it. And I'm always happy to take phone calls regarding that type of stuff. And some of the resources, both webinars that I've talked about today are all related to IRS Code Section 511 to 514. The third one down, Publication 598, that's a little bit easier of a read than the code, but I enjoy looking at the publications. The IRS really does a great job of putting a lot of information into those publications. The second one is an IRS website called stayexempt.irs.gov, and it's created especially for 501c3 organizations. So if you are a 501c3, take a look at that. It has some resources there. The last two are really about keeping up to date with what's going on with the IRS. I have a subscription, so I get emails from the IRS, and they send me new releases. They have webinars that have been very, very good. I've sat in on a few of them on different things related to not-for-profits. And if there's new form or guidance or other publications that have come out, you get notification of those. So it's definitely two things. And it doesn't come very regular, so it's not like you're going to get spammed with email all the time. So it's definitely something nice to get set up with. And that's the end of the webinar. Please email me or give me a call if you have any further questions about anything related to UBI. Glad you sat in on the webinar today and hope you have a great weekend. Thanks.